Commerce and Industry works to create and sustain an environment which is conducive enough to the growth of industry and trade in Gujarat. It has almost 4,000 plus direct members, which includes over 200 plus trade and industry associations and leading chamber of commerce from the state of Gujarat. In its efforts to promote the economic growth of the country and the state, GCCI has over the years initiated several focused and meaningful programs, dialogues covering various aspects of development. GCCI usually have an expert committees which devotes their attention and coordinate activities in their area of expertise. These committees also plans and implement exclusive events in their selected spheres. One of such is IPR Task Force, and here I once again welcome you on behalf of the Task Force Committee to this program. We had a task force, IPR Task Force, aim or have a desire to spread the awareness about the intellectual property in the states, and also to create the interest from the industry and to show them that what are the relevance of the intellectual property for the growth of industry in the states and into the country in turn. One of the such topic which we have selected today, and I'm sure one of my committee member, Darshan Patel, is here. He is being a chartered accountant. He will definitely go into the theme of the topic. But one of the interesting point which we brought it here today to discuss, and we have an eminent speaker from the Supreme Court Bar, Mr. Amar Dave. So this topic is something creating the nexus between the tax implications on the intellectual property rights, and specifically in respect of the transactional type. So with these words, I welcome you all once again, and I'm sure that we will have many things to take back from the this such interactions or debate or the webinar. With this word, I hand over to Darshan. Darshan, over to you.
At the outset, let me congratulate Sri Jatin Bhai, Chairman IPR Committee, who is vigilantly spreading the knowledge arena specifically for intellectual property rights for all our members. With these, allow me to share the theme of today's webinar, that is GST implications in intellectual property right matters. Taxability of IPR under indirect tax law has always been surrounded by various ambiguous interpretations, specifically with respect to transfer and the ownership aspects. Prior to GST, there were issues with reference to whether IPR is to be treated as good or IPR is to be treated as a service. Because when we say that it is a good, then it is a state has the power to levy taxes. And when we say that it is service, then union has the power to levy taxes. But due to the GST, the whole this particular matter or a question or a problem has been abolished, thanks to GST. But post GST also, still there are a lot of issues, and we have been observing that litigations are going on. Specifically with respect to temporary transfer, what is permanent transfer. There are issues for reverse charge mechanism on copyright aspects. There are various litigation for sale as unbranded goods. What is unbranded, what is branded, and so on. And for this, we have with us Sri Amar Dave. It is indeed my pleasure and privilege and honor to introduce Sri Amar Dave, who is an arguing counsel, Supreme Court of India. Yes, arguing counsel, Supreme Court of India. And when we say that Supreme Court of India, it itself speaks a lot. But for participants, and for their insights. I'm giving a brief introduction. Mr. Amar Dave has over 22 years of experience as a practicing lawyer in tax and commercial laws. He is arguing before Supreme Court as an arguing counsel for more than 17 years now. He has been appointed as amicus curiae by Honorable Supreme Court in various matters, including anti-profiteering matters under GST. Now, let me share what is amicus curiae. Amicus curiae is a position where a court appoints experts as their advisor in a particular case or a matter. So he has served in various matters. Apart from that, he is instrumental for various Supreme Court important judgments in the field of even Arbitration and Reconciliation Act, Limitation Act, Direct and Indirect Taxes, and so on. Among his clients, there are various famous groups like Tata Group, Kotak, Adani Group, Gujarat Pipavav, Torrent, Arvind, Core Healthcare Limited, and so on. And the list is endless. With this, I welcome Shri Amar Dave to share his insight on important topic, that is GST in the matters of intellectual property rights. Thank you.
Thank you for welcoming me, Mr. Patel and Mr. Trivedi. It's indeed an honor to be amongst you all today and the audience today on a very important subject which you have chosen. I'm not very sure whether I'll be able to add the kind of value which you are looking at, but I shall certainly make an endeavor to do so. But yes, having said that, I must state that, as you rightly said, this is a topic which really has a lot of contours and a lot of aspects which are still emerging. And therefore, as your members, being in the business, must be facing day-to-day issues with regard to that. It is an important topic. So with your permission, I may now start to give my presentation on the subject which was decided today. Well, before I do that, when I was requested to cover today's topic on GST implications on intellectual property right matters, my first spontaneous reaction, in fact, was that it's going to be a very intellectually taxing session for my audience. So please bear with me for some time till we cover these topics, which will add value to your understanding and for your practical purposes too, I hope. In fact, when the 101st Amendment was introduced, that is the amendment in the Constitution of India, whereby the entire setup of GST as we know today was virtually incorporated. And I still remember when this 101st Amendment, which was a historic step, was being undertaken, there were a lot of jokes which were floating around. And one of the jokes which I did receive on my phone read like this, that a wife asked her husband, "How much do you actually love me?" And the husband promptly, being a husband, responded 72%. Well, the wife was not very pleased with the answer. So she said, "Why only 72%? Well, the husband promptly responded and said, "Well, there is 28% tax on the GST on the luxurious items." So the point being that today, we cannot deny that the amendment in the Constitution, by virtue of which this thing was ushered in, was truly historic. Having said that, before I go into the issues which are together with IPR, it is important for me to basically state the constitutional amendment, because that is the foundation of the entire legislation. And whatever issues today we have outlined for this session, or which we face from time to time, you will realize that everything finally is flowing from what that constitutional amendment says. The entire GST system, the manner in which it has been incorporated, draws its source of powers from there. So any conflict of interpretation, we again revert back to those constitutional amendments. So undisputedly, the core recognition of the 101st Amendment in the Constitution is associated with GST, which resulted in subsuming of a number of indirect taxes into a unified GST, levied by the union government and the state governments. Adoption of GST undoubtedly rationalized the concept of one nation, one tax, one aspiration. This is the key to the entire aspect of GST, the way it was introduced. And it seeks to play a very pivotal role in catapulting the Indian economy, which we have been seeing since the time the GST has in fact been introduced. The earlier system of multiple indirect taxes at different levels of the value chain had started to plague the entire system, and clearly GST was a panacea to the same. The GST system was certainly resulted in a much simpler ecosystem as is in vogue today, as we are experiencing it as business members who are with us and also the professionals. In summation, this phase of fiscal unification was indeed historical. The new system targeted ensuring a more robust, efficient and consistent supply chains across the nation, consequentially realizing the goal of overall price rationalization. The cumulative effect of its adoption is the percolation of the ensuring benefits to the last mile consumer. Finally, it is the consumer who must get the benefit of the entire legal framework. And that is what this was targeted to. And to a great extent, it has been able to achieve those objectives. In addition to the above, it is in fact the tectonic shift in cooperative federalism. I want the members to please bear in mind in simple terms, as Mr. Patel, when he was introducing the subject, rightly said that not only were there issues whether this IPR aspects fell as goods or services, but look at it backwards. Earlier, there was a scheme whereby the concept whether the state would have the rights to tax a particular thing or it would be the central government. This GST system to a great extent ironed out those difficulties. And that is what is the main fulcrum of this entire amendment, because it was a classic case of cooperative federalism. As aptly observed by Justice Chandrachud in a recent judgment authored by him in the case of BKC's footsteps, the 101st Amendment was truly a watershed moment in the evolution of cooperative federalism. While time constraint of this session may not permit me to cover all the facets of the vast changes in 101st Amendment, I will straight away take you to the basic problem areas which got little rectified by virtue of imposition of the GST. Now, if we see, the constitutional provisions also amended the definitions of goods and services tax. Clause 12A read as goods and services tax to mean any tax on supply of goods or services or both, except taxes on the supply of alcoholic liquor for human consumption. It also introduced 26A to define services. If you note, the services have been defined to mean anything other than goods. So whatever doesn't fall in the category of goods has to classify itself as a category of service for the purposes of the new GST regime. Now, what did it basically take care of? The past system which was getting plagued. This system is based on multi-stage taxation. Now, when you buy raw materials, when it is manufactured to the sale, to the final, to the retailer, and then to the final consumer, there are different stages. So GST is basically a multi-stage tax. It is also a destination-based tax. So what happens is that the final sale to the consumer will be the definitive factor for purposes of deciding the revenue which has to be shared and where the tax would finally be levied. One important component which is a part of the GST is the value addition concept, because this concept truly ensured that the cascading effect which happens in the previous regimes before the GST was to a large extent addressed. If you see in the example which is visible on the screen, I will not take you through the entire one, but what you will realize it, that kindly see the first one, purchase of raw material by manufacturer. So his cost is say 2,000 rupees for purchasing the same. Let us hypothetically say that 10% is taxed only on the value addition, which is 200 rupees. So his total price is 2,200. When we go to the second one, which is the finished goods, it will be basically only the value addition which is which will be taxed. So if you are seeing on the screen, the value addition which is added in the second stage is only 500 rupees. So the 10% of the tax which now gets levied will be only on this 500, and therefore will be a component of 50 rupees. And therefore the final product, which when it leaves second stage, will only be 2,750 rupees. And finally, if you calculate for all the 4 stages, you will realize, because of the concept of the tax only being on the value addition, like from raw material, when you convert to a final good, the component is only the value addition which will get taxed. This resulted in totally taking care of the issue of the multiple taxing on the same issue without giving due importance to the aspect of value addition. So therefore, the next slide which you see on the screen will make you realize that the earlier systems, and I have only taken one of the tax components over here. In fact, you would recollect there were multiple taxes of different natures, VAT, various octroys and excise duty, which were there. So this one example will itself amplify what I am trying to state. If you see on the left side, the old system basically results in a final cost to the customer at 2904, because there are 2 components, the excise duty and the VAT. Now, if we see under the new GST system, as you are aware, the entire GST now subsumes all nature of taxes within itself. So entire concept of excise duty and everything now gets subsumed to that extent into this concept. And there we have on the aspect that the final figure which emerges, though this is hypothetical for purposes of indicating what is the result finally of this incorporation, kindly see, to the customer, there is a saving. And therefore, the entire purpose of GST has ensured this cascading effect to be removed. Now, the most important aspect, as far as we are concerned with, is the GST on supply, because supply is the most important component of GST. But today's topic is also revolving around the main component of intellectual property rights. Now, as you are aware, intellectual property rights offer owners of intellectual property the legal authority to prevent others from utilizing their creations or to define the conditions under which they can be used. IPR's ultimate goal is to provide customers with innovative, competitive goods and services that they desire and need. The advantage of an IPR-based system for innovation is that it offers incentives to further develop and commercialize publicly financed fundamental research, allowing new products, businesses, and even industries to emerge based on these innovations. IPR rights are now increasingly becoming an integral part of any business, irrespective of the scale of business, be it licensing of rights or perpetual transfer of such rights. Not only are they a part of the routine business transactions, but the frequency of such transactions is in fact increasing. Aspects such as the nature of the IPR transaction in a sale of the entire business as a whole, whether the sales of products are under a registered or a non-registered brand, whether the transfer of such IPR is for a permanent or temporary nature, as Mr. Patel started with, are all diverse issues of critical significance on the manner in which the quantum and the place at which GST would apply to such transactions. Hence, understanding the applicability, the implication, as also the scope of GST on such transaction is a must for any business of any size or any sector. Given the context and importance of IPR in a robust economy, it was natural that the government, being conscious of the unlocked value of IPR-related transactions, has well captured under the new framework, and inter alia become a major source of GST revenue. Accordingly, various aspects of IPR-related issues are embedded or are continuously being provided for under the GST framework. So realizing the importance of IPR in the context of GST, because it's a big money spinner, finally the revenues come from there. Therefore, there is an added interest in the concept of IPRs as to how the taxation under the GST regime will happen, and various components have been changed and looked at differently. And of course, there are even issues which have been arising from time to time. Now, as we started looking at supply in the GST regime is the most critical factor, because once you have supply established, you come within the realm of GST. Now, what does supply entail? It entails basically leasing, exchange of any nature, that is, you swap or transfer any equivalent with the use of money, whether you are licensing anything, a permission granted to exercise such privileges. We have so many licensing examples like softwares, we have licensing for using patented technology or whatever, many concepts. Then we have the concept of sale, where the entire transfer of ownership of goods happens. Then we have normal transfers, where transfer of goods or right in goods without the transfer of actual title. Then we used to have the old system of barter. We also have systems like where there is rental, which is a periodic payment for the use of someone else's property. And finally, the disposal, which is to part with or alienate with something. Now, if you see the 8 concepts which are reflecting on the screen, all 8, if established, result in supply of something. What is that something? It could be either service or it could be goods. The entire foundation of GST is, as you know, is either the supply of goods or services or a mixture of both. And therefore, it is important to understand what is the categorization of a particular supply. Whether it is a supply of service, then it would be covered probably under entry 5C of the Schedule 2 of the Act. What does it talk about? It talks about temporary transfer or permitting the use of enjoyment of any intellectual property right. What does the supply of goods take into within its fold? It takes into its fold, it should be entry A actually, you see C on the screen. Any transfer of title in goods is a supply of goods. Now the problem area is that in what happens, because goods in that sense have been defined under the Act. They have been defined to mean any kind of movable property except the one which are expressly excluded by the legislature. Now, because we don't have a definition of movable property under the GST Act, we have to look at that definition under an act called the General Clauses Act, which defines property of every description except immovable property to be a movable property. And therefore, this is the manner in which you classify under the GST regime. Either you fall as a supply being of service or the supply being of goods. Under the erstwhile regime of VAT and CST, as Mr. Patel had informed you when he introduced the subject, there were certain case laws which were available which held that IPR was in fact treated to be goods. Now, there are separate categorizations which we have in the GST regime just now, which basically provide for permanent transfer of intellectual property right in respect of information technology software, or permanent transfer of intellectual property right in respect of goods other than information technology software. Now, please bear here for a moment and please note that both concepts deal with permanent transfer. And therefore, the concept of permanent transfer is relatable to the supply of goods in that sense. Now, I will basically deal with one scenario as members of the business community being there, that franchisor business we are well aware of. We have lots of franchising business which are there, and we follow that model very regularly in our ecosystem today. We are aware of so many mouth-watering franchisee businesses like McDonald's or Subway and a lot of other ones which we are now used to. Now, what happens in a franchisor business is, you are aware that the franchisor gives basically various rights to the franchisees which they have in different cities or different locations. Now, as you can see on the screen, the right to use trademark, brand, or any other kind of an IPR is what the subject today is. And under this arrangement, generally there is a lump sum franchisee fee at the time of a franchise agreement, and coupled with that, they also have royalty on the gross sale revenue from the franchisee, which is also fixed. So generally, two components in this example, which we are dealing as scenario 1 today, is one, you receive a lump sum franchisee fee coupled with the monthly royalty on the gross sale revenue. Now, the question and the problem which arose in this context was that there are two entries if you see on the screen. Now, if you see, finally, if you saw the nature of the scenario one, you would realize that basically the person, that is the franchisor, is giving the rights of the IPR to be used by the franchisee for the business. So therefore, the first entry which is there was saying that licensing services for the right to use intellectual property and similar products, and then licensing services for the right to use trademarks and franchises. Now, on first blush, this seems to be the more apt entry for the scenario one, which we were discussing about. Because finally, you would ask yourself, the franchisor is basically, in that sense, giving the permission to use the trademark or the brand. A McDonald's would give the brand to be used by the entire different branches of McDonald's, which we know of in the city, as an hypothetical example. But the problem is that under a licensing, the right is basically, it is the entire thing is being shifted as a permanent feature. Whereas under this business of franchising, it is a fact that actually speaking, there is a difference between licensing and franchising. And that difference is on many counts. If you may see kindly, that licensing is an arrangement between a licensor and licensee, where the latter party would acquire the right to use products and goods, where ownership remains with the licensor. However, franchising refers to an arrangement between the franchisor and the franchisee, where the latter will enjoy the ownership of a business on behalf of the franchisor in lieu of a fee. What is that fee? Which we saw the two components, the franchisee fee as a lump sum and also a portion of the royalty. Usually what happens in a franchisee business is that the franchisor controls the business to a large extent. The involvement is much greater than what you have in a system of licensing. Because once the licensing is done, frankly speaking, the control over the business of the licensee is not there from the licensor. But that is a different connotation as far as the franchising business is concerned. So taking all this into consideration, the final aspect of classifying by one of the judgments by the advanced ruling authority was that it will in fact not be treated as a per se license, and it will be covered at the rate of 18% as a in the category of 99839, which you see on the screen, which is other professional, technical and business services, where the subcategory, the service code is provided as trademark and franchises. So this was found to be the more appropriate direct entry in the context of this particular scenario, which we are saying scenario one. And that decided the rate of GST applicable. So you see the reasoning which emerges is whenever we plan our business, the way we transfer our rights, the agreements which we get into, all play a very pivotal role in deciding what would be the rate at which the GST would be levied. We now come to basically scenario two. Now in scenario two, what is happening is that the franchisor first sets up an outlet and starts running it initially. He does not straight away give the same to the franchisee. After he has set it up and it's a running concern, in this particular hypothetical scenario, the franchisee again comes into picture as we saw in scenario one, but with a difference that first the franchisor has developed the store. He has taken the store on rent. He has taken the machines. He has set up the business. He started to run the business. And he has also, of course, been using his own brand for running that business. After all this is achieved, the franchisor then decides to sell off the business which he has developed to the franchisee, but on the same understanding as was in scenario one, that the brand which he has will be allowed to be utilized by the franchisee. So we again have here two agreements which will be entered into. The first will be a purchase agreement, by virtue of which the operating outlet will be sold with its assets, which are the machines, the other infrastructure. And the second would be the franchisee agreement, which we already saw in scenario one. So the second component is identical to scenario one. The first one is little different. Now, the issue which arises over here is that whether it could be construed as a sale of the entire business to the extent of that store by the franchisor to the franchisee. Again, as you are aware, under GST, that also has its own implications from the tax angle. Now, in this case, the advanced ruling authority again looked at the issues and said, finally concluded that, look, you are not selling your entire business as a franchisor. What you are in fact doing is one of the outlets which you have developed, the machines and everything and other infrastructure is what is being sold under the purchase agreement. Therefore, it is not a classic case of the entire business to that extent being sold, as was claimed by the franchisor in the context of this scenario. So it was only if you now, if you see the scenario 3, this would have made a difference, because here you will see that the franchisor, the master franchisor now is selling his entire business lock, stock and barrel as a purchaser to the to a new purchaser, and therefore the entire context which is different from scenario 2. In this case, you can safely say that the master franchisor has in fact sold the entire business or to the new purchaser, and therefore that is the key to decide what will be the tax implications accordingly.
Devangiben, sorry Amarve, Devangiben,
yes sir,
mute કરવું પડશે, unmute થઈ ગયું છે. Yeah, Amarve, sorry.
No problem, no problem. Is the screen visible, Jatin bhai?
Yes, very much.
Very well. Now we have come to another contentious issue which has arisen in the near past. As you are aware, as members of the association, that there are various kind of companies. I have taken this as an example as a foreign company for purposes of understanding, but you may also have the context of Indian companies there. Now, in many cases, what is happening, like for example, banks have various subsidiaries, suppose for different businesses, say mutual fund or hypothetically even running the banking operations. Now, if for example, hypothetically a foreign bank establishes various subsidiaries for its activities in India, we are aware that the brand which the foreign company owns is generally being used automatically by the subsidiaries. Now, the context which arises is there is no separate value as such which is assigned to this kind of a use of logo many times. Now, there has been in recent past issues which have been arising, because this is also a related party transaction to that extent. And if you see the section with regard to consideration and even in supply, because everything is supposed to be based after the first requirement of supply, as we saw, is established, then you have to see what is the consideration for that supply. So the chain is this, that first you have to see whether there is actual supply for GST to trigger. If you find that yes, there is supply, you have to see what is it. Is it a goods which has to be supplied, or whether it is a service which is being rendered? Once you establish that, you go on to the issue, what is the value for that activity? Is it, what consideration is being received? And there the context arises is if it's a brand which you finally are just allowing it as a matter of course to be utilized by your subsidiary, because your main chain of revenue is the activities of business which this subsidiary is taking. So you will basically take your revenue in terms of dividends or whatever back to the foreign company on that basis. But people sometimes don't realize that now under the GST context, even if you have not assigned a consideration, there will be a deemed consideration which will be treated for purposes of calculating your GST. And therefore, now the issue is arising that the department says that because of that triggering, what happens if you have not given any particular consideration and you are allowing the subsidiaries to basically use your brand? So there are issues which have thereafter arisen or even in that context. Now, because of the paucity of time, I'm sorry to the members that I'm pushing a little bit. We go to the next one. One of the other issues which are synchronized with the IPR issues and GST is the issue of registered brand vis-a-vis non-registered brand. Now, you see, when this was introduced, the concept whether this is basically an actual differentiation which is justified, or whether it is a retrograde step for the IPR regime, because you see many people started de-recognizing themselves because of the benefit they found in the GST system because of the being a non-registered brand and selling their products. Now, what I feel is there is an important requirement to balance the acts whenever a new issue is brought in. And therefore, when we are as an IPR also, because both are very critical aspects for our economy. One is the GST regime and the solidification of our IPR laws, which we have been consistently doing. Now, anything which runs at crossroads with these two must be ironed out at the earliest. Now, there must be incentivization, therefore, for registering your brands and something to be done in the context of the liability of GST in that context. Therefore, that balancing act is very material. Now, since we have basically looked at the issues which arise in the context of various IPR transactions and the GST implications therewith, depending on our business structures, we have a system now which was not there in the earlier tax regimes, which is again a very important aspect which has got introduced by the GST regime, is basically going to the advance ruling authority in advance. Now look at the practical side for a businessman. He is about to start his business. Generally in the past, we all are aware that after he used to be into the business for say 5 years, 10 years, there used to be certain issues under the various tax regimes which used to arise, which he could have avoided. Was he aware as to this is the position which the tax authorities were likely to take? We did not have a redressal mechanism in advance for that. It was only when the tax department or the authorities under the respective act took action that the issue arose. Now, under the advance ruling mechanism, which we thankfully have under this GST system, it's actually a blessing because you can go as a businessman and ask that this is what I intend on doing, or this is the categorization which I am looking at. And these are my justifications for doing it. And the advance ruling authority has been endowed with entire powers, which results in weeding out uncertainty for business members, and it reduces litigation to a great extent. And therefore, the mechanism which is provided under section 97 with appeal and a further appeal, of course, which is not triggered off, is something which is certainly a blessing in disguise for the entire system of GST. And therefore, whatever issues in terms of say scenario 1, 2, 3, or 4, which we discussed above, where issues are arising, they are all being ironed out by taking advance action from the concerned advance ruling authority. I have tried to put the entire issue as simply as I could, and I have been very grateful for the patient hearing which we have received from the members. I'm thankful.
Yeah, Marvi, thank you very much. Aditya?
Yes, sir.
Yes, may I request Aditya Yagnik, who is the member of the IPR task force, to coordinate for the question and answers, Aditya, in case, and then followed by the vote of thanks.
Sure, sir. Thank you, Amar, sir, for a very insightful webinar. It was indeed a privilege to hear you. The house is open for questions. In case should anybody of the audience has questions, may pose in the group. I'll take it over, and I'll let Amar sir address those. Please feel free. I believe there are no questions. None that I could see. Jatin sir, what do you suggest?
Yeah, let us go ahead with the vote of thanks. I request you to give a vote of thanks, Aditya.
Good afternoon, everyone. It was indeed a pleasure to hear Amar sir on a very insightful topic, more so it being so relevant in the present day and age. I am thankful for everybody to participate in this wonderful webinar on a Saturday afternoon. And thank you so much, Amar sir, for your valuable inputs. It was indeed a pleasure and a privilege to hear you. And I look forward to having such more webinars in the coming future. Everyone, please stay safe and look forward to see you all again very soon.
Thank you.
Darshan, do you want to add any, being a chartered accountant, do you see any comments on the what Amar Bhai has said? So, Darshan?
Uh, no, yeah, but there are problems for with reference to branded and unbranded. Say one few of the clients are doing both the things together. They are selling branded goods also, and they are also selling unbranded goods. So in a container or a say a sale mode, it is very difficult to manage both the things simultaneously because on a branded there is a GST, and on unbranded there is no GST. So there are a lot of litigations due to that particular aspects. So is there anything, sir, which we can plan for this particular situation to ignore and to omit any litigation with respect to branded and unbranded?
Well, the thing is that at the end of the day, if you can think of the two entities being separate is the safest, which is the possible answer. But if for practical purposes it is not possible, I very frankly believe that this issue will have to be thrashed out. As you saw in the slides, it is basically in conflict with the idea because it goes to the root of it. If you are going to basically disincentivize people from taking brands, you are basically undermining the entire purpose of IPR. And that is exactly what we saw as rightly these problems which are coming. But you are aware that a lot of people immediately took deregistrations also. Then they made that change with that if the deregistration has happened later, that it's a different context. But the short point being that at the moment, the only way you can do it is basically having a separate entity for the purposes of supplies. And that is
Right.
the way possibly you could alleviate the situation. But otherwise, if you fall in the definition, then certainly there is a problem.
True, sir. Thank you, sir.
Thank you.
I think we have a two questions. One is for someone named Mehak Kalsi.
Yes, good afternoon. This is Mehek. My simple concern is, as Sir pointed out, about registered and unregistered trademarks. So when we are talking to the clients and when we request them and convince them to get their marks registered, so how do we tackle this? How should we say that there will be no GST on unregistered brands? So how do we convince them? How do we incentivize? What should we say to ensure that even if there is no GST, they should be going ahead and filing for their trademarks?
Yeah, Mehak, that's a very important question because as you saw the entire thing, what is of my concern is that this step is actually undermining the entire regime of IPR. Apart from you see all other implications which you see under GST, the government has been very positive because they realize that it is basically an important revenue churner.
Right.
But when we come to IPR on this aspect of brand vis-a-vis the unregistered brand, there is a certain disconnect which I personally feel. Now, your question as to how to convince people in the teeth of this, especially small units and or mid-scale units, where they have to visualize the cost which will be of business in terms of paying the GST or their effect on the sales. Frankly speaking, that government, I am sure, is conscious of this, and something. If you see the recent look at it, it is within the domain of looking at it. But the IPR protection is not restricted. The very fact that if you allow this, the entire investment which you are making to build up a brand, it's the heart of your business finally as an IPR. If your heart of the business is going to get adversely affected at any stage, it's like an insurance, right? IPR is an insurance for the effort, for the entire investment which you are making, because finally you are developing the business from scratch. Now, if it emerges to a strong brand and you don't have the protections, or if you are only dependent on the common law protection as we know of, And now, with the recent judgments, we are aware that how the registered trademark not being there, what consequences happen. Now, those will certainly override the benefits which initially a person sees in terms of the lesser GST. And let us also not forget that GST finally is an indirect tax which is passed on to the customer. So finally, the customer, if there is strength in your activity of supplying, if there is strength in your brand, it will certainly override the cost effectivity aspect for the customer, because he will always be secure buying a brand from a reputed company rather than taking a risk of buying an unbranded product. And that historically has been proven. So I think those inherent strengths of the concept itself is what you need to highlight to your clients.
Thank you so much, sir. Thank you.
Amar bhai, we have one more person who wants to pose a question. Sumit Singh.
Hi, sir, Sumit here. So I have one question. So nowadays, every subsidiary of their holding company is using the trademark of their holding company, and in India, that is something which is under GST regime. Like it will fall under GST, that every subsidiary is required to pay GST on the trademark what they are using from their holding company. So there should be any arrangement between holding and subsidiary where they can prove that this is just a company arrangement, or how it should be done?
See, you are, I will initially say, and I think Darshan Bhai can add if he wishes to. You are aware that under the problem area is section 15 also basically talks about related party transactions.
Correct.
Now, if you don't assign any consideration, the scope of consideration which you see in the definitions, read with the entire section scheme of GST, gives ample power to read in consideration. And that's why if you saw that slide 4 which we were dealing with, this is the critical problem, that where people, in many cases, brands are actually transferred. I must confess that you in your business which you are doing, brand is actually is what you are giving as a critical aspect for your partner in the form of a franchisee, or in the form, as you are saying, to your subsidiary for use, because that is the enhancement which happens. Like even the banks, as we talked about, opening up branches. But the problem is if you don't assign any consideration, looking at the related party issue and the consideration which can be then deemed to be read in, is going to be more problematic. Now, the second part is how do you deal with it? Basically, I think you need to have a mechanism when you enter into the agreements to provide a reasonable consideration justified, because sometimes what happens is that while you are giving it to a person, even in related party transactions, so long as you are able to show the arm's length that this is being allowed to be utilized for the actual core business rather than as a brand, then those kind of inherent checks and balances may result in taking care of this situation. But this is an evolving situation where notices have been issued, as you are aware, and therefore the outcome of the litigation may take care of these situations. I think Darshan Bhai also wants to add in something.
Yeah, sir, I add on that in these type of transaction, we usually go for valuation of that particular brand which is being used by the subsidiary company. So when and these particular valuations are independent valuers. So when the valuer is giving, say, it is 100, then to that extent, subsidiary has to consume that 100, and GST needs to be paid. And for that particular GST, your holding company would be having an input tax credit.
Correct.
So this is similar to that transfer pricing.
Yes. Yes.
For that particular, you have to go to a registered valuer for the valuation and then do your transaction.
Yeah, I just wanted to add one thing, that yes, I missed out that point. Most of the times, if you have input credit tax which is available, it naturally gets offset. The problem is, that's why I highlighted the issue of the banks, because they are the ones who will get hit badly, because there is no possibility in certain scenarios to utilize that against the credit, and that's where the problem needs to be looked at more deeper. But yes, the solution which you are giving is the one which is being even done. But that's why I said, so long as you justify the relationship, and because even the valuation, as you are saying, will be looked at if there is a related party transaction in that sense.
Yes, yes.
So therefore, we need to be conscious to back it up with the actual agreements to reflect the nature of the transaction.
Correct, sir. So in addition to my question, so let's suppose that my parent company is not owning the trademark, but my ultimate parent company is holding those trademarks. So should it be considered as a related party transaction, and should I go for a valuation from a registered valuer?
Yes, two things on a lighter side. Jatin bhai will share because councils beyond a point don't like to.
I was
But
to,
I have
I
reached
was
my
to,
peak now.
I was to suggest to the Sumit that it's better to, we have a registered valuer here, Darshan Patel. I think
Okay.
he's the right one to connect with. And being a professional, obviously, before the clock starts from the Amarubhai's desk, it is better, Sumit, we should pause.
Yeah, but just to conclude, Jatin bhai, with your permission, as Sumit has raised valid points, and he has as Sumit, your last question is that could you repeat that question once, please?
So my parent company is not holding those trademark. My ultimate holding company is holding the trademark.
I see.
So those trademarks are registered in other zones or other country, not in India.
Right.
And I'm using just those trademarks just as a subsidiary of my ultimate holding company.
But you are using it under an agreement or a permission, because the structure will have to be seen. And I would suggest, I had appeared in one matter of Foster's, if I may be wrong on it. There was an issue of the situs of the brand over there. If you can look at that aspect, probably that may be helpful to you. But yes, just on the basic facts which you are saying, there will have to be a back-to-back agreements, and there will be a serious chance, as I am saying, of related party issue being raised on whatever valuation is basically placed. So long as your agreement is strong, it is based on the actual facts, and the valuation is justified, and the apportioning is justified for the India business context, I think you should be okay.
Yes.
Right.
Yes. Perfect.
Amabhai, we have a last two questions. Tushar is there. Tushar is one of our committee members. Tushar Shah is a company secretary. He has a question to pause before you. Tushar is there. Tushar?
Yeah, Jatin bhai. Yeah, good afternoon, everyone. See, I have a question. Like, say, for example, my subsidiary is located in USA. As we rightly say, as you currently, say that in respect of utilization of brand by subsidiary company, we should take care of GST part. Now, say for example, in my brand, suppose I'm not valuing my brand as such, my name is there. Like, I'm not doing my valuation of my brand.
Right.
So if my subsidiary is using that, say for example, my subsidiary is having the same registered office, or maybe my own brand. Say for example, Adani Realty or Adani Enterprise or Adani Port kind of thing. So is there any documentation is required if that my subsidiary is using that? My name is my brand ultimately. So is there any amount that I need to pay, or maybe any record we need to maintain between two subsidiaries?
Yes, Tushar bhai, that's a very important question. And from the business perspective, again, the questions which have come have direct bearing. You are right, as you saw in that slide which I pointed out, because this is actually a very critical issue. As you are aware, when you are not able to take the credit, this becomes a problem. And in the example which you shared, you see you have various companies which are running and using a common brand, whether it's, as we know in that term, Tata Group, Reliance Group, or Adani Group, as you rightly said. And there are various companies under the umbrella which are there, which they do their independent business. But the only point is that the brand is, of course, just getting added. They have their sub-brands which are registered under the companies which are running those operations. But the brand usage, as you said, because registered office may be common or not. Now, the question being, looking at the sweeping nature of the term consideration, and looking at the sweeping nature of the provisions of related party, it is advisable that certain value is assigned for that, and it is put on record to that extent. Because otherwise, if those are not available, then it gives rise to an issue of valuation on its own, which has its own aspects which you are aware of when it happens. Therefore, if it's a justified document reflecting these issues, then it can always be argued that it is on those basis that the entire thing is being conducted, and it is only one component which is being utilized. Rest of it is all basically the sub companies which are developing on their own, and the registrations are taking place.
Yeah, noted your point. But what happened is actually, see, for example, as a holding company also, I'm not creating my any brand valuation. Say, for example, Adani is already there, for example, or maybe Tata is there. So
Right.
what they are doing is they are known by their, governance and kind of thing. Now, whatever the expenses that I am creating for creating my trademark at that time, so I'm not creating any value over there. Even in my books also, in the ultimate parent company also, I'm not creating any value in my books. So how can I charge anything with my subsidiary, from my subsidiary? So that is the
what
point.
happens, Tushar bhai, is accretion of, see, if there are 10 companies doing different businesses, the brand is of course getting more popular, right? Does
Right.
it not lead to accretion of the brand as far as your from that angle, if you examine? I'm just putting it across.
Yeah, I noted your point. Yeah, I agree. But like, how, what should I charge actually? Like, see, suppose, say, for example, by getting registration, my ultimate holding company, I'm spending me, say, for example, 25 to 50,000 rupees in, registering my trademark and everything.
Yeah.
So what happened? My subsidiary is having the same registered office, my PEC, PRC license, shop and establishment license, everything comes with my brand. Like if I'm giving my NOC to my subsidiary company, so what they are doing is they are using my my registered office, my brand as a, it's being a subsidiary company. So what I ideally we should charge from my subsidiary as a part of that arrangement, or as a part of record maintenance also.
Yeah.
Tushar bhai,
Yeah, Darshan.
Amar bhai, allow me to share. Tushar bhai, basically, whenever your trademark or a brand is in-house, there is no accounting treatment in the balance sheet.
Right.
I absolutely, this is the current position. Now for your particular case, you have to value the intellectual property right, and that particular value will guide the GST. So I agree that there is nothing in the balance sheet, but then this particular transaction, there is valuation. What ultimately your subsidiary company is using brand of your holding company.
Right.
Because by using that particular brand, you are taking the benefit to your subsidiary company ultimately. So business by using the holding company's brand value, a brand or intellectual property right. For that purpose, you have to value, and on that value you have to pay the GST. That is the current position.
Yeah, I noted your point, Darshan, but currently what happened? Maybe खुद की holding company.
Tushar, sorry, can you and Darshan take it offline, please?
Okay, fine.
Yes,
Fine.
thank you.
Amar bhai, before we conclude, we'll just take a last question and a very precise. Gauri, is Gauri there?
Am I audible, sir?
Yeah, Gauri, be precise and a very quick question, please.
Yeah, good afternoon, and thank you for organizing such an informative session, actually. So, actually, I was hesitating because it is not directly GST only, but I'm just switching over from income tax and then IBBI, because the valuation point is now just came in the discussion. So my query is like this, 2-3 things. Like first thing, like 80 RRB is there, and whether in India, this benefit of 80 RRB is taken, because it is very difficult to see if anybody is taking that benefit. That is a one thing. And second thing, I'm just looking for IBBI when we are talking about insolvency, whether we are considering the proper valuation at that time of IP, and how we are taking into consideration taxation at that time. That are the 3 points I want your kind of on that.
Amar bhai, please allow me. I think Gauri, what we can do is we can share the email ID of Mr. Amar Dave to you.
Okay, fine.
Right, because I think he has to leave somewhere at 12:30.
Oh, okay.
So he's already getting late. But we got your question. So Amar bhai, is it okay if I share your email address with?
Yes. What I will do is Tushar bhai's query, and Gauri G's query. Both of the queries, please forward it to me. I will give a short response to both the queries. Give me, provide me 2-3 days because I will give it by next week. So I will address both the ones.
Okay, okay. Thank you so much.
Thank you.
No, sir.
All right, Amar bhai, thank you very much for the time you spared for us. And I think it was very interesting and the questions came out very unexpected. But thank you very much for dealing with it nicely. And I'm sure that the participants have satisfactorily got the answer of the same. So with this, thank you very much. Devangi Ben, if you have an email address of Amar bhai, let me just put it in the chat box. Amar bhai, is it possible for you to give your email address in the chat box, please?
Yeah, I'll do that. Just give me one moment.
I think I have it. Let me put it.
I put it.
Okay, thank you very much. And thank you all participants, Darshan and Aditya as well. Have a wonderful weekend. Thank you.
Thank you, everyone.
Thank
Bye-bye.
you.
Thank you.